That was a ET Now exclusive. Let's go across to the management at Quess Corp now. Ajit Isaac, Chairman and MD, is now joining us. Tell us about the announcement of Quess Corp. Now an East Bengal FC investor has come in.
Sure. So as a background, Quess has been growing and morphing from being a services provider to being a platform for products and services where we engage with a large number of customers, consumers, and individuals. Today we have 260,000 people who work for us. We manage about 220 million square feet of space in which about almost 2 million people work. So our engagement is with a large number of people at any point of time. Quess needs to develop branding initiatives, and in order to reach a large constituency of people, which is not demarcated by geography, economic strata, or any other categorization, we wanted to choose a medium that reaches as many people. Sport unifies, lots of people. Sport does not distinguish between geography or backgrounds of people, etc. And we wanted to use sport to reach as many people as possible. That's when we engaged with East Bengal about the possibility of investing there and building a branding initiative with the club. What we've now concluded is an agreement to invest in the club, to own about 70% of the club, and we will therefore, together with the club, participate in the development of football in India and reach our brand out to as many viewers as possible.
The company is also looking at moving to more non-linear growth that will also help the company boost its margin. When will we see 8%?
So 8% is a directional target, and it's a target that we set for ourselves a couple of years ago. We've grown from under 5% today to being close to 6%. We know we have visibility to maybe another 100 basis points. At 8%, we'll be among the world's best by margins in the business services space. We think that some of the investments that we will make in the future in the higher margin business will help us get closer to 8%. Also, our organic growth now is now trending to get at a higher margin level. So we think it's about 2 years of work.
Right. Integrated facility management currently is the highest margin business at the company, followed by technology services. How do you plan to grow these businesses?
So our facilities business today is among the largest in India today. We've got almost 55 to 60,000 people who work in that. We manage 220 million square feet of space, about 10,000 beds. We make about almost 150,000 meals a day. We think there is scope for getting more market share. That business can grow by at least about 20% year on year. We have a piece in the security services space as well, which we think has a lot of potential too. In the technology space, professional staffing is a stable business, is a mature business. In 2 of the countries that we're operating, in India and Singapore, we're number 1. And we have also recently added the infrastructure management IMS business in our IT services bouquet. So we see some growth coming from that. That business is also in excess of 8% margin. So both these businesses form a large heft in our and they together will contribute almost about 35 to 40% of our sales, and we think that this will help us in our margin expansion.
The company is increasing wallet share of existing customers by offering more services from building maintenance, recruitment, and managing IT infrastructure. What is the plan chucked out there?
Yeah, sure. We have about a few, 2 or 3 initiatives in the company that's being run to ensure that our wallet share increases. The first one is we've set up a cross-selling team that's able to meet customers who are availing of maybe one of our services and who are able to go and sell a couple of other businesses of ours as well. The second thing we're doing is we're opening branch offices in cities where we're expanding the reach of our geographic network. So we're able to provide more services to more number of customers on a geographical basis. The third thing is that we are employing a digital strategy for operations in the future. In a more digital world, we think we'll be able to reach a larger segment of customers more easily, and also provide a more automated way of providing services, especially at the lower end of the price point. So these are the 3 ways by which we hope to increase our wallet share with customers.
Can you tell us if you will be taking on more debt, or what's your debt reduction plan?
We have a significant amount of cash already lying with us, which we raised from the IPP. We also generate about 40% of EBITDA, of maybe almost in excess of 200 crores a year. We raise as cash. We generate as cash inside the company. Our prudential norm on, internally in our company is not to exceed 2 times EBITDA at any given point of time. So we don't have any intentions of going out to raise any more additional debt for the company. We are fully funded to finance our working capital increases through the internal accruals that we've got, and we think that we'll be further able to reduce our debt equity debt and the leverage position by using the cash we generate from operating cash flows.
You're aiming to double your revenue to $2 billion within the next 3 years and boost profitability as you target new business segments. Are you on course to meet targets, and what are the strategy in place?
Sure. So we have a revenue run rate of about $1 billion right now. We have a compounded annual growth rate of about 45% per annum. So if you look at the past and extrapolate the growth that we've had over the last 5 to 7 years into the next 2 years, we believe we have enough momentum in our business to be able to get to $2 billion in sales. I don't think it's an unrealistic target, especially since some of our acquisitions are beginning to kick in right now. And by 2020, we should be getting closer to this number.
Let's listen in to Shyam Shekhar. Thanks so much, sir, for taking